I want to ask you about value because Jeremy Grantham has always been associated with value. Value's underperformed growth for years. I think, except for 2022, S&P growth has outperformed S&P value over 20 years, 10 years, 5 years, and even year to date. It's underperformed. Value's underperformed. In theory, I'm a Jack Bogle guy. He believed in reversion to mean. This makes some sense to me. I think so. And yet it's not really happening in any big way. Can you describe why this is happening? What accounts for this long-term outperformance of growth over value, and is that going to continue?
Yeah, and we are value investors at GMO, but to us, value doesn't mean just a low price index. There's a lot of low quality cyclical businesses that can't really differentiate and are kind of going nowhere over time. We like to talk about intrinsic value, which is companies that can grow and grow at a high return on capital and that can be reasonably priced. And that kind of company has been doing very well. And I think that kind of trend can continue as long as there's innovation and growth opportunities going forward.
Yeah, and yet, Nate, year to date, as I said, growth is outperforming value. Not only that, but the flows are going the same way. Growth ETFs, I think you gave me this, $16 billion in inflows. Value ETFs, $6 billion in outflows. So we had that one good year in 2022, but we're back to the trend of growth over value, and the investor seems to smell that again.
It's amazing. I mean, there's been a massive performance spread this year between growth and value. I show over a 30% differential in performance. If you compare, say, the iShares Russell 1000 growth ETF to the Russell 1000 value ETF, if you think about this, that's a really tough pill to swallow for value investors after, to your point, it appeared value was turning the corner in 2022 following years of underperformance. You look last year, value outperformed growth by 22%. So I think coming into 2023, a lot of investors expected that to continue. It's been the exact opposite.
Yeah, and yet everything has a price, right, Tom? I mean, if value is not cheap enough, it eventually will get cheap and somebody should buy it. In theory, if you believe in reversion to the mean, I know value guys, we debate about China all the time. There are value guys who don't care about the political debates in China. They'll buy if it's 14 times forward earnings or less on a certain index in China and don't care about anything else. Why isn't value get cheap enough for it all of a sudden to outperform? I mean, even crummy stocks, you know, that don't have much earnings growth do have a price. Everything's got a price where somebody will buy it.
Yeah, but I think if you look at those crummy stocks in the market today, they're not particularly cheap by historical standards. Really, so the action is in growth. Value's gone nowhere. And we've seen a lot of interesting things going, obviously AI and stuff going on this year. There is a lot of innovation. And from a point of view of a value investor, while some of the most well-known stocks, maybe at kind of frothy valuations, there's a pretty big supply chain, pretty big ecosystem there. So there's a lot of growth at a reasonable price, high-quality opportunities to invest.
So is it that value has, it's not value is dramatically underperformed, it's growth is dramatically outperformed?
I think that's the way to think about it.
A certain way to look at it. I mean, when you get top 10 stocks up and 30% on average, that's pretty remarkable overall.
Yeah, this is an unusual environment where there are so many opportunities for large cap equities. You don't normally see that.
Nate, does this whole game of growth versus value make a lot of difference anymore? This is one of the longest old school debates I've ever had, growth versus value, in terms of a factor debate. Maybe it's just obsolete these days. Maybe we should just stop debating this whole game, and some stocks are, growth prospects and others aren't, and just forget about it. I've been doing this for 30 years, and after a while, I just want to say, well, it's time for everybody to move on.
Well, you're right. It's always a compelling argument to just own the S&P 500 and not attempt to split into factors. But, to what Tom was saying, if you look, a lot of gross performance this year has been driven by the so-called Magnificent Seven, because if you look at many of the growth indices, they're pretty top-heavy. And so the largest growth companies have been enough to really drive that performance differential versus value. And I would say, even if you look a layer deeper than that, obviously the artificial intelligence mania we saw earlier this year, that's been a big driver of mega cap tech stocks. And then I think you have investors just anticipating or assuming the Fed will cut rates at some point, which theoretically would help growth. But to what you're saying, do you want to attempt to play all of that or just own the S&P 500? The other thing is value tends to be pretty heavy financials and energy. You look at the performance of both of those sectors this year, it's been very underwhelming.